So who enjoys paying taxes? Well, certainly not me, but they are a part of life for many of us. So I prefer to pay only my fair share and not a penny more. So my goal for you is to be aware of the top tax deductions for 2023 and 2024 so that we can make this obligation less painful. First, let's go over what a tax deduction is and what a tax credit is. So tax deductions are incentives the government writes into the tax code that allow you to reduce your income by a certain amount if you qualify for them, reducing the amount of tax that you may have to pay. Let's say, for example, that you made $100,000 in income, but you had $15,000 of various deductions. You wouldn't be taxed on $100,000, your taxable income would be $85,000. A big difference. Now, while a tax deduction reduces the amount of income that you're taxed on, a tax credit is even more valuable. A tax credit is a dollar-for-dollar reduction in the amount of tax that you pay. Let's say, for example, that you owed $20,000 in taxes, but you had various tax credits for $5,000. Then you would only be required to pay $15,000 in taxes for that year. Now that we know the difference between a tax deduction and a tax credit, let's go over the top 24 deductions and credits for the 2023 and 2024 tax year. But before we do, this is a perfect spot to point out important disclosures. The information in this video is for informational purposes. This is not specific financial planning, health insurance, or investment advice. In addition, everyone's tax situation is different. You should discuss your tax situation with a qualified tax advisor before implementing any tax planning strategy. All right, here we go. Do you own a home? If you rent, you're SOL, but if you own a home, the government provides several incentives to reduce your taxes. First, the mortgage interest tax deduction allows you to subtract the interest that you pay on a qualified mortgage on your primary residence or a second home that you don't rent out from your taxable income. A lot of people don't know that this applies to that cottage or summer place or winter ski cabin, fishing cabin, something like that. So your primary home and your second home. There is a limit depending when you got each mortgage on the amount of interest that you can deduct. And in order to claim this deduction, you must itemize There's the home improvement tax deduction. This allows for annual non-refundable tax benefits when you make improvements to your primary home that are considered to be beneficial for energy efficiency. You can potentially deduct 30% of the cost of eligible home improvements made from 2023 to 2032. It's up to a maximum of either $1,200 or $2,000 depending upon what you had done. Some items that qualify for a $1,200 deduction include new exterior doors, windows, skylights, and insulation. Exterior doors are limited to $250 per door, up to $500 total. Windows and skylights have a $600 limit. The 30% deduction up to $2,000 typically includes items like heat pumps or boilers, so those larger, more expensive items to install. You can also deduct state and local real estate taxes that are based on the value of your property. But your total deduction for state and local taxes is limited to $10,000. $5,000 if you're married filing separately on an annual basis. Now, sports gambling, that's taken off in the past few years as numerous states passed online betting. Did you know that gambling losses can be deducted as itemized deductions? So there is a silver line for all those bad beats, but you can only deduct losses up to the amount of your gambling winnings. So make sure that you hold on to those losing ticket records. You'll need those if you plan to implement this write-off. Now, the federal government allows parents to claim some tax credits to offset the costs of raising children. There's the Child Independent Care Credit. I call it the daycare credit. It allows you to claim a percentage of your qualifying care expenses while you're either working or trying to land a job. This is an actual tax credit and phases out as your income increases. It also depends on the number of dependents that you have and how much you spend on the care. In addition, there's an adoption credit that can help cover some of the expenses related to the adoption process, like traveling, legal and processing fees. This credit also has an income limit. The child tax credit for the 2023 tax year is $2,000 for each dependent. This tax credit also has an income limit where the credit is reduced for incomes above certain levels. The credit does have the added caveat that it is refundable up to $1,500, meaning if you are able to reduce your tax burden to zero, you can get up to $1,500 back with this credit. Not a lot of other ones do that. All right, here are the ways that you can potentially reduce your taxes if you are in college or incurring student debt. Now there's the American Opportunity Tax Credit, or AOTC. It's for eligible students who pay qualified education expenses for the first 4 years of higher education. The credit is worth up to $2,500 per year and has a refundable portion of 40%, meaning it can create a tax refund of up to $1,000 if you don't owe any taxes. Just remember, if you're in years 5, 6, 7, or 8 of school, that you can't continue to claim this credit. All right, now let's talk about the student loan interest deduction. This allows you to deduct up to $2,500 of the interest that you paid on a qualified student loan. The deduction is also based on income limits and phase-outs like the tax credits, and it's non-refundable. There's also the lifetime learning credit. This allows you to claim 20% of the qualified post-secondary education expenses that you paid for yourself, your spouse, or your dependent during the year at a qualified school, up to a maximum of $2,000 per tax return. Hey, did you know that teachers can deduct up to $300 annually for unreimbursed classroom supplies? I know a lot of the teachers in my area, they're always buying supplies for the kids because they want extra things. This deduction is available even if you don't itemize deductions on your tax return, which is pretty cool. So just make sure that you keep your receipts if you plan to claim this deduction. If you know a teacher, make sure they know about this deduction. All right, now, if you're self-employed or you own a business, many expenses are deductible. Make sure that you're taking them. If you own your own business and use part of your home for business purposes, you may be able to deduct a portion of items like mortgage interest, homeowner's insurance, utilities, repairs, and depreciation. Typically, you can deduct the percentage of the expense that corresponds to the percentage of square footage your home office represents. For instance, if you have a 200 square foot dedicated home office and your home is 2,000 square feet in total, you could then deduct 10% of those expenses because your office is 10% of the overall home square footage. Anyone who's considered self-employed needs to pay self-employment tax. There's different forms of self-employment that include gig workers like Uber, Lyft, or DoorDash, contract workers, or freelancers. The good news is that self-employment tax can also be deducted, which reduces its impact somewhat. Medical expenses, those can be really costly, but thankfully there are ways to reduce those costs if you understand the deductions. So there's a medical expense deduction for self-employed people. They may be able to deduct health insurance premiums, but you cannot deduct any premiums that are more than your net profit from self-employment. Make sense? You can deduct the premiums from the business as long as you have net income to support it. And no matter whether you own a business or not, everyone may deduct any unreimbursed medical expenses that exceed 7.5% of your adjusted gross income if you itemize your deductions. Now, if you have a flexible spending account or an FSA through your employer, the money you contribute is deducted from your income. If you do it one better and you establish the triple tax-free health savings account, then your contributions are tax deductible and reduce your taxable income. In addition, you have up to your tax filing deadline to make contributions for last calendar year. So what about retirement plans? In order to incentivize you to save for retirement, the government provides many deductions and even some tax credits to help you build your retirement plan. Have you heard of the Savers Credit, the Tax Savers Credit, also known as the Retirement Savings Contribution Credit? It's a tax credit for people who are over 18, not a student, and not claimed as a dependent by someone else. It's up to $1,000 if you're single and $2,000 if you're married. If you're single, you must have an adjusted gross income below $54,750 in 2023 to claim it. And if you're married, your AGI must be below $73,000. The crediting rate ranges from 10% to 50% of your contributions depending on your adjusted gross income and your filing status. To put it simply, the lower your income, the higher your credit rate. This is a credit that's not widely talked about, but if you're just starting out in your career, or if you have a lower income, or if you temporarily lost your job, this may be a tax credit to consider. Now, when you have a 401k plan, you can elect to defer a portion of your salary into the retirement plan to reduce your taxable income by that same amount. Those contributions can be invested and remain tax-free until you withdraw them later on in life. There are limits to how much you can contribute to a 401k plan. In 2023, that figure was $22,500. In 2024, the amount rose to $23,000. But if you do a traditional 401k and you defer that, you reduce that income by the amount that you put in the plan. What about individual retirement accounts or IRA contributions? Well, those are available to almost anyone, but they're only deductible if your incomes are below a certain limit or if a 401k is not offered to you by your employer. You may be able to deduct the contributions into the individual retirement account, or the IRA as it's called. The limits for those contributions depend on your year and your age, and these limits generally increase every few years. All right, now that we're done talking about retirement plans, we all know that we should be a little bit better to our environment. Well, in an effort to incentivize us to do so, the government now offers tax breaks for clean energy improvements. So make sure you remember these if you bought an electric car or you made energy efficient improvements to your home. If you purchased an electrical vehicle, you can get tax credits that will help you offset your taxes. But these credits are cumbersome and depend on a number of things, like where the batteries are manufactured. Thankfully, auto dealers are pretty informed on how to help you apply for those credits if you look to purchase an electrical vehicle. The Residential Clean Credit allows you to claim a percentage of clean energy improvements that are made to your primary residence, like solar panels and geothermal heat pumps. This credit covers 30% of the cost of new qualified clean energy property for your home installed from now through 2032. What's also pretty cool is that many states incentivize this as well by offering tax credits on top of the federal one. Lastly, but certainly not least, contributions to charitable organizations can be deducted against your income. So the amount that you've donated can then be itemized on your tax return and will reduce your taxable income. If you donated an asset like a stock bond or an ETF, or a property like an old car, you can deduct the current market value on your tax return. So look, most people think the tax code is about taking money away from you, and I get it. But in reality, roughly 90% of the tax code is about strategies that you can use to pay less tax. So make sure you're getting yours, because many people don't, and the government will never come find you to give you money that you should be receiving. Make sure to review these deductions and the tax credits with your accountant to make sure that you are applying any that you should be getting. And if you forgot about them, you can go back and amend up to the last 3 years of tax returns to maximize missed deductions. Learn more about tax saving strategies by watching this video next.